Hi class, today we're going to be looking at Chapter 9 and we're going to be discussing the allowance method for uncollectible accounts. I'm sharing with you an Excel spreadsheet that I've created for Chapter 9, Problem 1B. And today we're going to be looking at the allowance method for uh, accounting for uncollectible accounts. And when we talk about the allowance method, there's some things that you need to know about this particular method. First of all, there are two ways that you can determine the uncollectible amount. And we're going to be using both methods today. In the first part of the assignment, we're going to be using the analysis of accounts receivable method. And in the second part of the problem, we're going to be doing the percentage of sales method. Now, both of these ways we can use them to estimate uncollectible accounts. We are using the allowance method. So again, this is the allowance method that we're going to be doing to record uncollectible accounts transactions. And so when we talk about the uncollectible accounts, what we're talking about is not being able to collect some accounts receivable that we have established for customers that we've sold merchandise to on account. For some reason or another, our customers are not going to be able to pay us. And so what we find ourselves doing is in certain situations where we know that the customer is not going to pay us, or if there's a certain period of time that has lapsed that we haven't received payment from that customer, then it's probably a good idea to go ahead and write the customer's account off of our books. So when we are using the or when we are trying to decide how to approach these uncollectible accounts, we can decide to use a method called the allowance method. And when we use the allowance method, we are usually going to use this for companies that have a large amount of uncollectible accounts. There is another method, which we're not going to be describing today, but is fully described in your textbook as the accounting for uncollectibles using the bad debt expense method. In this particular problem, we're going to be discussing the allowance method for accounting for uncollectible accounts. And because it's the most widely used method, that's another reason why we are just going to be discussing this particular method. Again, we're working on Chapter 9, Problem 1B, and they want us to analyze the following transactions that have occurred here. But before you do anything else, they want you to record a credit balance of $50,000 in a T account that is presented below for requirement 2B, which is the allowance for doubtful accounts. So this allowance for doubtful accounts is the new account that they introduce in this chapter that you will be using with the allowance method. When you are using the allowance method, we're going to be creating an adjusting entry at the end of the company's accounting period to determine how much of the accounts that we've established are going to be uncollectible in the future. This allowance for doubtful accounts is a contra account that we are going to be using when we establish the adjusting entry to estimate how much uncollectible accounts we're going to have in a future period. So you might remember from chapter 3, we talked about our first contra asset account, which was accumulated depreciation. And you'll remember that we said that all contra asset accounts are offsetting a certain asset account. Well, this is true for the allowance for doubtful accounts. It will offset the accounts receivable account. And because it will offset the accounts receivable account, it's going to have a normal balance on the credit side. You'll remember that we said that the normal balance of an account is the side that the account increases on. So allowance for doubtful accounts increases on the credit side because it is a contra asset account. Allowance for doubtful accounts is going to offset our accounts receivable on the balance sheet. We only use the allowance account when we are writing off accounts and when we are estimating the amount that will be uncollectible in the new period. We can also use the allowance for doubtful accounts when we are reinstating an account that has been previously written off. So they want you to put the balance in first. You'll notice that I've filled in some other balances, and these balances are coming from the journal entries that I'm about to prepare for you. So since I worked this ahead of time, this is the only part that they want you to put in part 1. Record that there is a credit balance in the allowance for doubtful accounts. And because the allowance for doubtful accounts is an estimated amount, sometimes if we write off more accounts receivable than we anticipated, we could swing over into a temporary debit balance in the allowance for doubtful accounts. So it's very important that you read your problem carefully to see where the balance was to start with. In this case, they told you that it was a credit balance of $50,000. So we're going to enter that on the credit side for January the 1st. That's the first thing they wanted you to do in this requirement. The second thing is to journalize these transactions. So let's start with the January 19th transaction. On this transaction, they stated that we are going to reinstate. That means we're going to put back on our records an account that has been previously written off under the allowance method. We're going to put it back on the accounts and we're going to collect it from the customer. Now, the types of transactions that you're going to be working on mainly in the estimating of uncollectible accounts is recording adjusting entries and doing what we call a write-off of an account and also a reinstatement of an account. So this is an example where we're going to reinstate an account that has been previously written off, and we're going to be receiving in this transaction $2,660 in cash as full payment of Arlene's account. So there are really going to be 2 journal entries when we reinstate an account. The first journal entry is going to put the accounts receivable back on the books. So what I've done here is I've created a journal entry on January the 19th where I am debiting the accounts receivable of Arlene Gurley. I'm debiting the accounts receivable because I'm reestablishing the account. I'm putting it back on our books that was previously written off. When we do a write-off entry using the allowance for doubtful accounts, we will uh, debit the allowance account to reduce it, and then we will credit our accounts receivable. That's the write-off entry. So when you reinstate an account and put it back on the books, you have to reverse out that write-off entry. And so we end up debiting accounts receivable to put it back on the books, and we'll credit the allowance for doubtful accounts, because we're really saying that we had written it off earlier. Now we are going to be able to collect from this customer. So it really was not a doubtful account. We are able to collect from that customer. So we reduce, or actually we credit, which means we're going to increase the allowance for doubtful accounts. We're going to put it back into the allowance for doubtful accounts. And we're going to also recreate our accounts receivable that was previously written off. So accounts receivable is an asset account. And when we reinstate the asset account, we are going to debit it. Our allowance for doubtful accounts is a contra asset account. And when we credit this account, we are adding to the account. So let's look at how we posted the allowance for doubtful accounts for the January 19th transaction. You can see here that we copied the allowance for doubtful accounts into the T account here. This is what we mean by posting to that account. And we credited it for $26.60 because the allowance for doubtful accounts was credited in this situation. So you're going to keep a record of all your transactions that flow through the allowance for doubtful accounts. So as we create them, I'm going to show you how to post it to the allowance for doubtful accounts. So we had a beginning balance, and then on January 19th, in the first journal entry, we credited our allowance for doubtful accounts because we had to put back on an account that we had previously written off. On January 19th, we would also receive cash from that transaction. Notice that they told us that we received $2,660 in cash in full payment of the account that we had previously written off. So a reinstatement of an account requires two journal entries. One to reinstate or put back on the books the accounts receivable that was previously written off, and the other transaction is to record the cash that we have received from this January 9th transaction. We debit our cash to show that we are receiving $2,660. We're going to credit our asset account accounts receivable for $2,660. So you really created what is called a wash for accounts receivable. Notice how you debited it here and you took it back off the books as a credit here. It kind of zeroed out the accounts receivable account, but now you have cash and you've had to put back into your allowance for doubtful accounts, which you had previously written off. So on the next transaction, which happens to be April the 3rd, we are writing off $12,750 balance that was owed by the Premier GS company, which is bankrupt. So a lot of times in today's world, when you have established an accounts receivable, sometimes the customer cannot pay you. And in this situation, this customer has declared bankruptcy. So you probably have received some documentation from the company's lawyer saying that this company is bankrupt and not going to be able to pay their bill. So what you would do on your books is you would write off the account of the Premier Company, and we're going to create a write-off account using the allowance method by debiting the allowance for doubtful accounts. We want to reduce the contra asset account allowance for doubtful accounts when we're creating a write-off entry. We also want to reduce the accounts receivable by the customer that we are writing off, which is the Premier Company. And so we would debit the allowance for doubtful accounts and credit accounts receivable to write off the account. In this case, we wrote off $12,750. Because when we write off an allowance for doubtful accounts, when we write off an accounts receivable, we debit the allowance for doubtful accounts. We're going to need to post that to the allowance account. So you can see here where we debited the allowance for doubtful accounts. Let me get on the right one. On April the 3rd, we debited it for $12,750. You can see where we posted it here in our allowance for doubtful accounts. So you're keeping a running balance of your allowance for doubtful accounts as we go along. You've written off the Premier Company's account that was worth $12,750. You're taking it off of your books because you've received notification that this company is bankrupt, and you're most likely not going to be able to collect any of this amount here. So starting with the next transaction, which is July the 16th, in this transaction, we've received 25% of the $22,000 balance that was owed by the Hayden Company. They are a bankrupt business. They could pay you a little bit. They could pay you 25% of the balance that they owe to you, but the remainder of that is going to be written off as uncollectible. So you have two journal entries that you're going to make for this particular transaction. The first journal entry, I'll go ahead and receive my cash. By debiting the cash, we're stating that the cash has increased by $5,500. That's the amount the customer paid us. And that $5,500 is found by taking $22,000, the total amount of their customer's bill, and multiplying it by 25%. So we're going to be receiving cash of $5,500. We will debit our cash account for $5,500. We're going to credit our accounts receivable for $5,500 because we've received $5,500 in cash from the Hayden Company, who owed us a total of $22,000. But we're going to credit their accounts receivable for $5,500 because we did receive cash for that part of the account. That 25% of the $22,000 is going to be reducing the accounts receivable account as well as increasing our cash account. In this transaction on July the 16th, they told you that they were going to write off the remainder as uncollectible. So we've received 25% of $22,000. We're going to write off 75%, the remaining part of this $22,000. So if you multiply 75% times 22,000, you're going to debit your allowance for doubtful accounts because we're writing off the account receivable for Hayden Company for the remainder that we haven't paid for. So 22,000 times 75% is 16,500. That would be debited to the allowance for doubtful accounts and credited to the accounts receivable account because it was written off. They have to credit the accounts receivable, which is an asset account. So you're making the accounts receivable go down here. Notice when you combine both of the credits to the accounts receivable is for the full amount that was owed of 22,000. So we wrote off 75% of 22,000. This is my write-off entry that we completed here. And we received in 25% of the amount that was owed by the Hayden Company. So we collected our cash and then we wrote off the remainder in the next journal entry. So on November 23rd, we have a new journal entry. And this one is stating that we are going to reinstate the account of Harry Carr, which had been previously written off 2 years earlier as an uncollectible account. We're going to record that we are receiving $44,000 cash in full payment of the account that we previously wrote off. So because it was written off, we got to reinstate the accounts receivable just like we did in the first transaction. We're going to debit our accounts receivable for $4,000. We're going to credit the allowance for doubtful accounts because you're reversing out the write-off entry. So for example, this was the write-off entry for the Hayden Company. If we're reversing it out, we're going to debit accounts receivable and credit allowance for doubtful accounts. We are reinstating the Harry Carr Company account, and we have to reestablish the accounts receivable by putting that back on our books for the amount that we're receiving in cash, which was $4,000 that was given to you. Our accounts receivable is increasing. Our allowance for doubtful accounts is also increasing. Remember, allowance for doubtful accounts is a contra asset account. So on November the 23rd, we would have posted as a credit to the allowance for doubtful accounts our reinstatement entry. We're putting this back on or into our allowance for doubtful accounts account. Also on November 23rd, once we reestablish the accounts receivable, we're going to receive our cash in, and we're going to end up crediting the accounts receivable account for Harry Carr. So make sure you put the customer name in there. I noticed that I had left that one off, so I just now included that. So we reinstated an account and then we wrote off the account here for Harry Carr. Let me go back for just a minute to the July 16th transaction. Yeah, we talked about that. I was thinking that I'd gotten lost a little bit here and where I was specifically, but we were on transaction for November 23rd. So we're getting ready to do our first transaction on December 31st. Notice December 31st is the end of the accounting period for this company. Their fiscal year ends on December 31st. They've told us in the instructions. So it's the end of the year. We're analyzing our accounts and we're seeing if some of the accounts need to be adjusted. And we're finding that we need to write off the following accounts on December 31st. So you had the Cavey Company, the Fogel Company, Lake Furniture, and Melinda Shriver, who are not going to be paying you what they owe you. So we're going to have to write off their accounts. Now you can do them separately, write off one at a time, but if you do that, you'll run out of lines on Cengage. So they're asking you to put it as one compound entry. So we're going to write off 4 different accounts in a compound entry on December 31st. We're going to debit our allowance for doubtful accounts. Now, you're probably not going to know how much this is that we need to debit until you write down all the things that you're writing off. We're going to write off the accounts receivable account for the Cavey Company, which was $3,300. We're going to write off the Fogel Company at $8,100. We're going to write off Lake Furniture at $11,400, and we're going to write off Melinda Schreier at $1,200. So rather than doing these as 4 separate entries, they combine them all together here, and they have one debit to the allowance for doubtful accounts. This is a write-off entry for each of these 4 accounts. Notice we debited the allowance for doubtful accounts for the total of all of our credits, which were to accounts receivable for each one of these individual customers. So if you add up all of your credits, that's how I'm getting the $24,000 that would be debited to the allowance for doubtful accounts. Remember that we're posting as we go along. So when we debited the allowance for doubtful accounts, we're going to put it into our ledger account that is set up as allowance for doubtful accounts. You're going to put it on the debit side since this was a write-off entry. When you reinstate, you credit. When you write off, you're going to debit it. Now on the next December 31st entry, we're going to prepare an adjusting entry to estimate the amount of the uncollectible accounts. It's very important that you read your transactions carefully. They're telling us in this transaction that we are basing this adjusting entry on an analysis of accounts receivable, which has a balance of $2,350,000. We've analyzed accounts receivable. This is their balance, and we're estimating our uncollectible accounts to be as a part of an analysis of accounts receivable. When you are doing an adjusting entry based on the analysis of accounts receivable, there's a rule that I've stated here in bold that you have to know. So when the uncollectible account is based on an analysis of accounts receivable, which it said that we were in the second December 31st transaction, this is what you have to do. You must take into consideration the balance that is in the allowance for doubtful accounts before you can create the adjusting entry. If there is a debit balance in the allowance for doubtful accounts, this is what you're going to do. You're going to add the uncollectible amount to the debit balance to get the adjusting entry amount. If there is a credit balance in the allowance for doubtful accounts, you will subtract the credit balance from the estimated amount to get the adjusting entry amount. It's very important that you learn this rule when we are analyzing uncollectible accounts based on an analysis of accounts receivable. An analysis of accounts receivable is going to tell us that we have to take into consideration this rule before we can prepare our adjusting entry. So you've got to take into consideration the balance that is in your allowance for doubtful accounts before you can make the adjusting entry. The balance before the adjusting entry is a credit balance of 3,410 because in this year we didn't write off as much as we had originally estimated. So we had a remaining balance before we create the adjusting entry. At December 31st, that remaining balance was 3,410 as a credit balance. So remember, in part one, we put the beginning balance in. This came from last period's ending balance that's brought forward. And then we analyzed these transactions. And every time we had a credit to the allowance for doubtful accounts, we put it in. Every time we had a debit to the allowance for doubtful accounts, we put it in. We're now at the end of the accounting period at December 31st, and we're trying to prepare our adjusting entry. So we have to come up with a balance before we can determine the adjusting entry amount. This balance before the adjusting entry is 3,410. It's a credit balance. So in our rules, if there is a credit balance in the allowance for doubtful accounts, you will subtract the credit balance from the estimated amount to get the adjusting entry amount. This company has estimated that there will be 60,000 that's uncollectible. That was a given amount. So we take 60,000 and subtract 3,410 from that. And that tells us what our adjusting entry amount is right here. Again, 60,000 that we estimated minus the balance that is in the allowance for doubtful accounts, which is the credit balance here. You are subtracting this 3,410 from the 60,000, and that will give you this adjusting entry amount here. So this is 56,590. To create the adjusting entry, we are going to create an account called bad debt expense. Bad debt expense is created in the adjusting entry for the allowance for doubtful accounts. The amount is 56,590, which is 60,000 minus the balance that is in the allowance for doubtful accounts. That's in cell address E24. So that balance, the estimated amount was given of 60,000 in your December 31st transaction. You're going to subtract from it the balance that is in the allowance for doubtful accounts before you can create this adjusting entry. The reason is we have to find this amount right here. Our bad debt expense will be debited because it's an expense account. We're going to credit our allowance for doubtful accounts because we want to increase the amount for the next year. So when we create the adjusting entry, we'll credit the allowance for doubtful accounts and we will debit the bad debt expense. The only thing I did here is I just posted this. Bad debt expense was debited for $56,590. That's what we did here. And then we credited our allowance for doubtful accounts for $56,590. That's our adjusting entry. Now notice that when we balance the account, the balance before the adjusting entry was $34.10. When we add the adjusting entry amount to this, we get an ending balance of $60,000, which was the original amount of the estimate that they wanted here, the 60,000. See how this balances with this? And the only time we have to take into consideration the previous balance in our allowance for doubtful accounts is when we are analyzing the accounts receivable account. And that's what we're doing in this transaction here. Now, on the next part of this is they're getting you to think about what will happen on your financial statements. And they're asking you to determine the expected net realizable value of the accounts receivable. So the accounts receivable balance was $2,350,000. This was given in the December 31st transaction. You see here that this is the balance of accounts receivable. So that's what we're going to put on our balance sheet, is that balance. It's given in the December 31st transaction. You're going to subtract from it the accounts receivable account, your allowance for doubtful accounts. Remember, we said that was our contra asset account, and the ending balance that we found was this 60,000 right here. So when we subtract the allowance for doubtful accounts, this is what we think is going to become uncollectible of the accounts receivable balance. When we subtract that, what's left over is what we actually think we're going to be able to collect of our accounts receivable. So we want to make sure that on our balance sheet, we have reported our accounts receivable at their net realizable value, because what this is saying to our owners or our investors of our company is that we anticipate that we're not going to be able to collect part of this accounts receivable account. It wouldn't be right for us to say that we're going to have accounts receivable and not show the allowance for doubtful accounts if we are expecting that part of these accounts are going to become uncollectible. Unfortunately, when we allow customers credit, we don't know if they're going to pay us or not at the time that we allow them credit. So what happens is we sometimes get stuck with an outstanding accounts receivable. And when we determine that we probably are going to have to write off some of those accounts in the future, we don't know which ones they are, obviously, or we wouldn't have allowed them to get credit from us. So we make an estimate of that at the end of the accounting period. And that estimate was 60,000 that we estimated to be uncollectible of our accounts receivable. So 60,000 subtracted from our accounts receivable account will leave you with the net realizable value. And the net realizable value would be found on the balance sheet. On the income statement, we'll have the new account called bad debt expense that would be listed in the administrative expenses section on the income statement. So this one's going to go on the income statement, and this is going to go on the balance sheet. Now in part 4 is a what if analysis. And so they're going to change around some things that you were doing previously. In this what if analysis, they're telling you that assuming that instead of basing the provision for uncollectible accounts on an analysis of accounts receivable, the adjusting entry on December 31st is based on the estimated expense, which is 0.5% of sales. And the sales was 15,800,000. So this is a what if analysis that's saying, well, what if instead of basing the uncollectible accounts on an analysis of receivables, we just use the percentage of sales method to determine our adjusting entry amount. So what they're saying here is that all of these transactions that we originally did are okay, except for the adjusting entry. Now the adjusting entry is not based on an analysis of accounts receivable. It will be based on the percentage of sales. So we're taking a whole different approach to find the adjusting entry amount when we're using the percentage of sales method. And I have a notation for you there, and this is very important. When you are basing the adjusting entry on a percentage of sales method, you're simply going to multiply the uncollectible rate by the sales to get the adjusting entry amount. We no longer have to determine what the balance is before the adjusting entry, but it might be a good idea to do that. So I've recreated the allowance account. I put everything in there exactly the same till we get to the adjusting entry amount. To determine our adjusting entry amount, we're going to multiply our sales, which is 1,580,000, by 0.5%, which is 0.005. So 0.5% is multiplied by our sales to get this adjusting entry amount. The adjusting entry amount is $79,000. Notice the debit and the credit for the adjusting entry, the account titles are the same as they were before. The only thing that is different is our adjusting entry amount. So when you post this adjusting entry, the allowance for doubtful accounts is credited for $79,000. When we add that to the previous balance, our new balance in the allowance for doubtful accounts is $82,410. This new balance will affect the net realizable value on our balance sheet. So they ask you to determine the bad debt expense for the year, which the adjusting entry amount, if it's based on a percentage of sales, we just multiply the uncollectible rate times the sales to get the bad debt expense amount. We enter the bad debt expense amount in our ledger at 79,000, and this bad debt expense will end up on your income statement in the not the adjusting entry. No. It'll end up on the income statement in your administrative expenses, 79,000. It goes on the income statement. But the allowance for doubtful accounts is a contra asset account. It ends up on your balance sheet. So to determine the net realizable value of accounts receivable, we write in the accounts receivable balance, which was given, and we subtract the balance that is in our allowance for doubtful accounts that was based on the percentage of sales method. We subtract this from our accounts receivable balance to get the amount that we expect that we are actually going to collect of the accounts receivable for this period of time. So that's how they get the net realizable value amount. So what we've done today is we've talked about the allowance method. And in the allowance method, we use an allowance account. And that allowance account is a contra asset account. We use the allowance account to write off accounts that are going to be uncollectible. We use the allowance account to reinstate accounts that are no longer considered to be uncollectible. And we use the allowance account to record our adjusting entry that we create at the end of the time period, which will estimate the amount of our uncollectible accounts. So we're using the allowance method. The first adjusting entry, we base the allowance method on an analysis of accounts receivable. And then in the second method, we based it on the percentage of sales that we think is going to be uncollectible. And so those are the two methods that I want to emphasize to you today. And I hope that this has helped you a little bit in analyzing the uncollectible accounts. So we'll stop sharing this with you. And we'll see you again next time. Bye-bye.